Welcome to a very important pre-budget Indianomics. With the stock market down about 5% from its all-time highs and down about 4% in just 2026, first 20 days, there is some hope that the Indian government should lower long-term capital gains on equities. On the other hand, the lower capital gains on equities appears to have pulled money away from debt funds and from banks in particular, hurting debt capital and, of course, bank margins. Today, I have with me three best-in-class experts to analyze the impact of the very high difference in capital gains between equity and debt, as also the high tax on interest income. Joining me are Mr. G. Mahalingam, former Executive Director of RBI and former whole-time member of SEBI, Anant Narayan, former banker and former whole-time member of SEBI, and Srinivasan Varadarajan, former Deputy Managing Director of Axis Bank and former Chairman of Union Bank. As I told you, expert bankers and financial experts. Gentlemen, and Mr. Mahalingam, thank you very much for joining me.
Morning.
This very important discussion. Mr. Mahalingam, let me start with you, sir, since you have been in both regulators. What, according to you, is becoming the impact of this very high capital gains tax on equity and fixed income, a very high difference?
Basically, if I have to start with a prelude, obviously the tax policymakers look at scenarios where they would like to achieve greater financialization of the savings. Okay. So if we view from that perspective, giving a kind of a tax dispensation which is of a higher magnitude on the equity looks justified. But then at the same time, I would like to look at the tax as something where actually a bit of a risk offset takes place, which means you are encouraging the financial savings to come into a riskier financial class, but then you are going to do a bit of a risk offset by keeping the tax slab rates a little low. In fact, I did an analysis the last about 25 years. The CAGR of the equity markets in India is close to about 12%. But the bonds have been yielding you hardly about 6 to 6.5, and the bank deposits somewhere close to that. So there is a yawning gap between the bank deposit rates and the bond yields and the equity market returns. They're so high, basically, I'm meaning that when you talk about long-term capital gains attracting a tax rate of 12.5, and the bank deposits and the bond interest rates are being charged tax at the income tax slab, basically it means almost about the taxation on the bond interest rate and the bank deposit income is almost twice of whatever is the tax slab applicable to the capital gains. So this is where I feel that we need to do some kind of a tweaking. I'll stop with this. Yeah. Maybe I'll come back in detail for the next.
Point taken. Just one point I wanted to tell you. Instead of twice the interest, my sense is it is 3 times now. LTCG on long-term equity is 12.5, whereas most people on interest income are on their slab rate, which is 33 to 42% in the case of HNIs. But Anand, you wrote an excellent piece on how this yawning gap, and by the way, I looked at the LTCG for many countries on equity and debt, and on LTCG on equity and interest on interest income. The data will flow. The gap is the highest in India. In many countries, it is the same. LTCG is also the same. Interest income tax is also the same. What do you think is the outcome of this very high difference in capital gains?
Ata, before I answer the question, let me sort of give you my thoughts on what Anant and Mr. Mahalingam have said. I think let's invert it a bit. I fully agree with what they've said, but let's invert it a bit. I think if you look from a government perspective, I'm trying to see why exactly, because this is something which has been debated for years together and things have not changed. So if you're sitting in the government and you're basically saying the equity allocation of individuals in the country is extremely low.
Point taken, sir. Well, the more important question I want to ask you is this current account deficit at 2.5%. We thought we could manage all these years. Now it looks like the capital flows are not coming. Also, what can this budget and next budgets do? Those questions after the break.